Hello, welcome European listeners and market participants, and welcome to KBRA's latest European Credit Podcast. I am Gordon Kerr, Head of European Research at KBRA, and today I am joined by my colleagues Ken Egan from our Sovereign Ratings team and Karim Nassif from our Project Finance Ratings team here at KBRA. So we are dealing with an energy crisis here in Europe. A large focus lately has been on Russia and the shutdown of their gas pipeline, the Nord Stream 1. It is being shut down on a temporary basis for the purposes of repairing some parts of the pipeline and maintenance. However, there are concerns as to whether or not this will return in terms of Russia turning the pipeline back on, whether or not they will return it to full capacity. And of course, just generally speaking about a shift of Europe away from dependence upon Russia for its gas supplies. So today we're here to talk to my colleagues about this situation. And I'll start off by asking, Ken, how did we really get here in terms of this emerging energy situation and in particular with regards to dependence upon Russia for gas?
Yep, thanks, Gordon. So I guess Russia's invasion of Ukraine on the 24th of February this year caused shockwaves around the world, particularly in Europe. While the overall trade between the EU and Russia has reduced from around 10% to around 5% over the past decade, energy supplies, particularly gas from Russia, are still crucial to the proper functioning of Europe. If we think of industry, for example, especially in the largest economies like Germany and Italy. Germany relies on around 60% of oil and gas for its primary energy input. And Germany had sort of banked on cheap Russian fuel for many years, and now it seems it's been snared. We've been looking at reduced gas flows, as you mentioned, through the Nord Stream pipeline from Russia into Europe in recent months. But in recent weeks, that gas flow has dropped to around 60% of capacity. Perhaps it's Russia's response to sanctions imposed as a result of the war in Ukraine. But if you look at other gas supplies to Europe, like the North Sea or North Africa, they haven't increased. So that's why we have this squeeze on price amongst other factors as overall supply is lower. And now further to this, as you mentioned, Nord Stream 1 has been put offline since Monday, closed for repairs. So the EU is facing a period of no gas supply from Russia, and market speculation is rampant about the future of this supply. On the one hand, you could say that Russia will turn the taps back on as it won't be willing to lose one of its biggest customers in the EU, and that it benefits from high prices on the supply squeeze. Perhaps it can exert more pressure with reduced flows. But either way, European sovereigns are scrambling for new supply lines, initiating contingency and emergency plans, preparing for the worst and preparing for a total supply cut. And I guess there is a difference for European sovereigns between market price for gas, which will impact cost of living, and actual supply, which some sovereigns will struggle with more so than others, Germany, for example. So following the aforementioned reduced gas flows from Nord Stream 1 pipeline, Germany said it was activating the alarm phase of its emergency gas plan on the 23rd of June. This is a precursor stage to an emergency phase whereby the state would begin to intervene in the market and ration supply amongst households, industry and government entities. Back in June, Italy and the Netherlands also warned of potential gas emergencies.
Thanks, Ken. So you mentioned there, Germany and Italy in particular. I mean, these presumably are the countries that are most impacted economically. So, are there any others? And also, what is the potential situation from an economic perspective and the impact of the shutdown?
Yes, that's a good question, Gordon. I guess it comes down to capacity and infrastructure in terms of supply. And on the face of it, it seems the most vulnerable sovereign and perhaps the one with the greatest impact given its place within global trade is Germany. As we said, Germany relies on oil and gas for around 60% of its primary energy. And before the war, it imported about a third of its oil and over half of its gas from Russia. Gas is a massive input for German industry. Similarly, in Italy, which also imports a lot of gas from Russia, it's also an important input for Italian industry. But the difference here is Italy has the infrastructure and a gas supply from Africa. And recently, the sovereign has made great strides to reduce reliance on Russian supply and increase imports from North Africa, Algeria in particular. If we look at France for a comparison, about 7% of gas imports come via Russia. And France has a somewhat diversified supply, both in terms of LNG capacity and supply from Norway. Now, as mentioned previously, although governments might step in to mitigate energy costs and the cost of living related to this crisis, some sovereigns like Germany, the actual supply could be a problem over the short term given the infrastructure in place. So for a rough guide on the impact of all of this, in May, the European Commission estimated that a full cut to Russian gas supply would reduce EU growth rates by 2.5% and 1% for 2022 and 2023, respectively. A paper from Germany's Bundesbank predicts a short-run GDP decline of between 0.5% and 3% for German GDP growth, depending on the restriction of gas supplies. Banca d'Italia also conducted scenario analysis on the theme. In the central bank's most adverse scenario, whereby there is a lasting supply cut of Russian gas, Italian GDP could contract by 0.5% this year. And currently, Banca d'Italia expects 2.6% growth this year. So it's quite a big contraction. In its baseline scenario, the Spanish central bank predicts possible near-term negative impacts to GDP growth of around 1.4% for the Spanish economy, 1.5% for France, 2.6% for Germany, and 3% for Italy. And based on the current economic growth forecast, this would drag some of these economies into recession. So while the estimates of the exact economic impact arising from a cut to Russian gas supply greatly vary, the overall outlook is quite negative. KBRA also conducted some rough high-level estimates trying to isolate the impact of a gas supply shock on GDP. In our baseline scenario of elevated gas prices and a 60% reduced flow from Nord Stream 1, we see very little impact on France, a 1.3% GDP hit for Germany, and a 1.1% hit for Italy. In our crisis scenario, so peak prices for gas and a full cut to Russian supply, we see GDP reduced by 2.8% for Germany, 2.3% for Italy, and again, a more limited for France, 0.3%. We would note that there are other factors and spillover effects that compound this issue, and these don't feed into our model. Factors like inflation, impact on disposable income, and then ultimately impact on demand. Now, I would stress the situation is both fluid and highly uncertain, but I guess as an initial guide, we would view this crisis as slightly less severe than some of the other market participants.
Excellent. Thank you very much, Ken. That is very interesting. So, Karim, taking that on board, this impact that is likely to happen with regards to the economic situation. When we dig down a little bit further and start to look at the corporate sector, what sectors are we expecting to witness the greatest impact from a shutdown?
Yeah, sure. Thanks, Gordon. I think the situation is very much how we had foreseen it might evolve earlier this year with the volatility in commodity prices. It's just been exacerbated now with the actions taken. And I think the entities that are most exposed are indeed the companies in the private and public sector that must pay higher commodity costs, but aren't able to pass these on to customers or are maybe forced to buy at unhedged prices. So in our outlook for project finance infrastructure, we talked about utility distributors and suppliers of commodities. These entities are exposed. We saw some insolvencies in the UK towards the back end of last year. We also continue to see pressure a number of utilities and retail supply companies in terms of their ability to make profits and mitigate the volatility and the input cost. Honing down to the individual sort of country and broad sectors, we also see in Germany in particular, the industrial sector being particularly impacted. And we're thinking here, the downstream chemical production sector, a very important sector for German exports. Now that business is exposed. We see other manufacturing businesses in Germany, whether it's iron or steel or ceramics, for example. The glass industry, in our view, if there was a complete blockage of Russian gas flows, industrial gas consumption could be reduced by 53% potentially, and that would lead to a 48% fall in production from the glass industry. So these are the kind of important numbers to consider. Having said that, Clearly, the EU nations that are most impacted, here we highlight Germany and the industrial sector, they will take action and they will be looking to provide whatever support they can to the exposed entities. And we see, for example, in June, the German government announcing a 15 billion credit line for its main gas operator, Trading Hub Europe, to purchase natural gas and fill storage facilities. It's important for the storage facilities to be properly filled to meet EU guidance and indeed EU requirements to have tanks filled up to 80%. So all these actions by governments would be expected to step in to provide the support for critical industry and critical entities.
Thanks, Karim. So I guess this sort of, this puts us in a situation to, I guess, theorize or think up what the potential is for Europe and Germany and Italy to counter the potential for a shutdown or slowdown in the provision of European gas and oil. How do you view the situation in Europe and the potential for that to occur?
Yeah, I mean, I think the EU was quick to announce national plans to cut 2/3 of Russian volumes through alternative supplies by the end of 2022. Now, clearly, LNG is going to play a principal role here, but it's not just LNG. It's also demand-side management. It's also looking to enhance renewable production. It's also looking at ways in which the households could participate. We talk about demand-side management, the role of solar rooftop panels, for example, the role of, for example, controlling energy consumption within the home and within offices and within businesses. Countries are looking at what would a 1 degree drop in the temperature set by the thermostat have on, gas dependency. And all these things are being looked at the moment. But looking specifically at the LNG question, I think what's interesting to note is that there is some spare capacity in Europe today in terms of import capacity. So on the LNG side, the EU imported 730 terawatt hours of LNG in 2021 compared to a capacity of 1,900. There was also around 650 terawatt hours of unused pipeline capacity in 2021. So there is spare capacity. The challenge now, to a large degree, is how are they going to receive, who's going to be providing the LNG? The US has already pledged an important amount to Europe, 15 BCM. And based on the first quarter, the amount of increase in supplies from the US, where they're almost sort of 60-70% of the way there in terms of meeting the pledge. In terms of Norway, they've announced 8% increase in gas supplies to the bloc. In terms of the UK has already boosted supply. There is a general recognition that there's about 50 BCM of global LNG supply that is not bound by a particular destination through offtake arrangements, whether it's from the US or producers or Qatari producers in the GCC. There's about 50 BCM of global LNG supply. Just to put that into context, the EU imported 108 BCM last year. So it's an important amount of free LNG that could go to Europe. But there's going to be challenges with getting that LNG into Europe. First of all, there's going to be competition with other markets. So whatever free LNG the US can divert to the EU or the GCC or other countries, there's going to be competition from other markets. So potentially there'll be a price premium that the EU will have to pay to gain that LNG. There's also going to be the challenge of infrastructure within the EU. And I think Ken pointed out earlier, there are pipelines obviously from Norway to the EU. There's, some LNG terminal capacity in Spain and Portugal, but still within the EU, transporting gas once it's been regasified is a challenge. And that's something that has to be looked at. So it's not just about getting the LNG, it's also about how it can be distributed to the countries that need it. And also, obviously, the cost of supply will be for the EU to think about.
Thank you very much, Karim. So to just sort of sum up, I think I would say that there is a currently difficult environment facing Europe with regards to Russia and the prospect of reduced gas supplies as well, both from a demand side, as Europe wants to transition away from Russia, as well as the supply side with Russia potentially not bringing back online the pipeline shutdown currently in place once its repairs are done. But while there is a potential major impact, as Karim has just highlighted, there is also the prospect for change, at least in the medium term, as either controls around demand side of things from consumers and businesses, or from the supply side through alternative sources. So if you would like to find out more information on the topic, please our research on kbra.com. Thank you very much for listening. We look forward to bringing you more conversations in European credit. And of course, don't forget to check kbra.com for our latest ratings and research. And we wish you all a pleasant summer as we head into the August quiet period. We will speak to you again soon. Thank you very much for listening.